Welcome. I'm glad that you're here. I took a look at the bank earnings today to see what they had to say about recession and to see why the markets reacted the way that they did. I have BlackRock pulled up, Bank of America, and JP Morgan Chase, and we'll take just a brief look at that and talk about what happened with the markets. Also, consumer sentiment came in today, and also that had its own impacts, and we'll see what's going on with that as we go forward, moving towards the January 27th release. Also, a little bit of talk about the PPI, which comes out on Wednesday, January the 18th, and the PCE, which is part of personal income and outlays, that comes out also on January the 27th. And then finally, what do we think it means for the FOMC meeting that takes place on January the 31st through February 1st? And with that, most likely, most probable 25 basis point hike that we'll see. So with that said, let's move right on to the information. The first bank that we'll look at today is BlackRock, and in their earnings report, they don't really mention much of anything in terms of recession. We have just these highlights down here with employee compensation benefits decreasing 129 million from the fourth quarter of 2021, and then also a restructuring charge of 91 million. And when they say restructuring, that is most likely, and you can see evidence of it down here, about their initiative to modify the size and shape of the workforce to align more closely with strategic priorities. So those strategic priorities, I'm guessing, with this slimmed down that they have and paying severances and accelerating amortization expenses and previously granted deferred compensation awards, that is all attempt to sort of trim the fat out of their budget and be just a leaner company in preparation for 2023. So that could be a little bit of something coming from BlackRock. And then over here from Bank of America, they mention about primarily driven by a dampened macroeconomic outlook and loan growth. And we get just a little bit from the CEO as well. Don't exactly know how to say his last name. I said Moynihan. I guess that's probably close enough. So Brian Moynihan, the CEO, talks about ending the year on a strong note with growing earnings in year over year in the fourth quarter, in an increasingly slowing economic environment. And that's what we get from the earnings report itself. The earnings calls might be a different story. Right here in Jamie Dimon, the CEO from JP Morgan Chase, just to put it on screen for you. Down here we have his take on the economy, saying that it remains strong, consumers spending cash, business is healthy, don't know the effects and headwinds coming from geopolitical tensions, so we'll see what happens there. It mentions about vulnerable state of energy, food supplies, persistent inflation that is eroding purchasing power, and also the higher interest rates and unprecedented quantitative tightening. So the Fed could have a whole lot to do with this still, and we'll see if the Fed holds out until March for their pause or if they hold out until June for their pause. I can't imagine, just from how things look right now, assuming macroeconomically everything stays pretty stable for us and inflation continues its current downtrend that it's on, or if we stay around, like for the CPI, for example, for core CPI, that 0.2 to 0.3% month over month that we have, I can't imagine that the Fed will tighten much more than they do. So 25 basis points coming up February the 1st, and then when March comes around, I'm not sure if March's date, another 25 basis points, and then by the next time they meet, I don't know that we'll get another rate hike at that point in time. We'll have to see what plays out as time goes on from the different reports that we get over time. And then, of course, looking at geopolitical tensions. So things change for the worse for Russia and Ukraine, bad for markets, possibly bad for the economy. And then if things go better, if for some reason that there's a deal met and peace is found, that could be something very, very good for markets. So the bank earnings were something that initially pulled the markets lower right at the open. However, I believe it was at 10 a.m. we had the consumer sentiment survey. So if we go over there, we can see for the index of consumer sentiment that it moved back up to 64.6, where it was at 59.7. And so it's not quite as high as it was January a year ago. However, it is moving up, and you can see this little chart that we have here. And pay attention to those bottoms for consumer sentiment. So back in 2008, and then after that, somewhere around, looks like 2012 and then 2023, we could be near a bottom for consumer sentiment. And honestly, for their inflation expectations that they have here, they say that the inflation expectation fell to 4%, down from 4.4% in December. And that's just the preliminary results for the consumer sentiment survey. The final results come out, again, January the 27th. They actually say it right here about the next data release. For the final January data, 10 a.m. on the 27th, which is after the PCE, which is released at 8:30 with the personal income and outlays statement. So Friday, January 27th could be a very big day. So I think that it could be something that could be very positive for us, and we'll have to see what the market looks like around those days. If it's kind of been gloomy and some bad news that has pulled it down recently, and then we move on from there to have it be like, hey, euphoria, wee. So we'll see if we're down low on the fear and greed index, and we're very fearful, and then this really positive news comes out, and then that can really possibly turn us around. And I don't want to keep going down that rabbit hole because honestly, it's so far out from now. I don't even know what's going to happen on Tuesday when markets open, let alone what's going to happen on Friday, January the 27th. So I'm going to move on from that speculation into the PPI release calendar. I have my research nearly all put together for this, and I'll be releasing it this weekend, January 18th, 2023. So that's on Wednesday. So that'll give you time to watch the video, digest the information, do your own research, and poke around a little bit and see what you think will happen around that date according to the PPI measures that we get from that. I also mentioned the personal income and outlays in their calendar, January 27th, and this is released at 8:30 a.m., much like the CPI is released at 8:30 a.m. So this is one that comes out an hour before market open on January the 27th, and that could be a very good print for us. Very good to neutral. I don't think we're going to get something bad here. Got my fingers crossed that it's very good. I want to polish up some of my research on that, but the preliminary look from the research that I've done into the PCE and what I know about its relationship to the CPI, we could be in for a good thing towards the end of January. And then the final thing that I want to mention is the FOMC meeting. So you can see that they meet January 31st through February 1st, and then we should find out that hopefully we're getting that 25 basis point hike. If we get 50, the market is not pricing in a 50 basis point hike. That could be something that would smack us back down to the ground pretty quickly, that the Fed is still that hawkish and wants to keep moving us down. March, it's not till closer to the end of March that we actually get another one. And I think that those headline numbers that we get through core CPI and also through CPI using all items, when we get to July and we see some of those numbers come out after June's big run up and we see those year over year numbers, we're going to see astounding drops in that headline number. Whoa, my chair just shifted there. That's a perfect time to let you know that a pony walked up to a man and said, "Pardon me." And the man said, "Wow, your voice is really scratchy." And the pony says, "I'm a little hoarse." So in July, when the CPI comes out for that and we see the headline numbers for June, I believe that they're going to look incredible, assuming that we're still in that same downtrend that we're at now, that we stay neutral to low on the month over month, the summertime. Like if we're not pausing sometime in the summer, like I said, I only think that there's 225 basis points hikes left, and that's January, February, and March, just so they can keep their game faces on, and then sort of ride things out from there. And then hopefully in 2023, they finally admit, even if it's not until Q3, Q4, so September, October, hopefully September, they're like, all right, well, I suppose it's a little bit too much. Things have slowed down, and we're ready to start pulling back from this a little bit and easing up on those rates and move into a slight quantitative easing, even if it's not a complete unwinding to a low interest environment. That's what I have to end this week for you for Friday. I hope that you enjoy your 3-day weekend in the spirit of Dr. Martin Luther King Jr.'s birthday. Somebody who was a fan of education. Why not take the time to learn something, to move yourself forward in your own life? That would be an excellent thing. Being that you're here watching this channel, I'm guessing you're that kind of person that does that already. So why not keep going? So thank you very much. I'm Dr. Stock, Doctor of Education. If you want to support this channel, check out the links down in the comments. See you in the next video.